The companies that we invest in as dividend growth investors are high quality, and high quality companies tend to raise these payments over time. Those 40 cents turn to 45 cents to eventually 50 cents and so on. Those payments grow, they don't stay the same. So I've been getting asked lately, how does dividend investing actually work? I mean, is it even worth it to pay hundreds of dollars and only get a few cents back? And what about the payments themselves? Do they stay the same or not? Things like that. So I figured I'd answer these questions for you guys in today's video to hopefully give you a much clearer understanding on how things work. All I ask for in return is a quick thumbs up on the video, as it does help out with the YouTube algorithm. And with all that being said, let's get to it. So dividend growth investing is essentially putting your money into high quality companies that reward you with cash in the form of dividends for investing in them. And not only do these companies pay you completely passive income, they raise these payments over time as well. This is essentially a way to invest for cash flow and passive income, money we don't have to work for. Which actually brings me to a question that I get asked quite often. What's the point of putting, let's say, $100 or $150 into a company, only for us to get something like 40 cents back, for example? And I get where you guys are coming from 100% when you ask these questions, but check this out. The companies that we invest in as dividend growth investors are high quality, and high quality companies tend to raise these payments over time. Those 40 cents turn to 45 cents to eventually 50 cents and so on. Those payments grow, they don't stay the same. And by getting the money that these companies pay you and investing it right back into them creates a snowball effect. Their next payment is going to be a bit bigger than the last one, and so on. The more times you reinvest the dividends these companies pay you right back into them, the faster they start to grow. This process is called compound interest. It's essentially earning money on your money. The growth of your money starts small, but as time goes on, it gets so much quicker. And since we're investing into strong, stable, and profitable companies, the stock price tends to go up over time as well. Check this out, you guys. Starbucks is a company that I happen to own in my portfolio, and they just recently announced that they're raising their dividend by 10%, from 41 cents a share to 45 cents a share. I also currently have 4 shares. They used to be able to pay me $1.64, but moving forward, they're gonna pay me $1.80. This is a raise that I got for doing absolutely nothing but buying and holding the company. Now I know this payment might seem small and insignificant, but check this out, you guys. My investment journey is just starting. Imagine when I get to owning 40, 50, even 100 shares of Starbucks. That's $46 from one company every 3 months. Those dividend raises are much more significant at that point. And the best part about it is, I have 44 other businesses doing the exact same thing, paying and raising those payments as well. All I really do is invest that money and wait. It slowly gets bigger over time. I could literally set my portfolio to auto invest. Stop putting my money into any of my companies right now. Come back in a few years' time, and those same companies would have gone up in price, and the dividends would have gone up drastically as well, due to them getting reinvested every time they're paid out, and those companies increasing those payments as well. Now that's powerful. I've essentially set up a process where I get paid regardless of whatever I do. Now I personally want passive income from my investments, so naturally dividend growth investing was right up my alley. One of the best perks for me is how we're allowed to get a return from our companies without ever having to sell them. So they grow in price and they grow on the payments that they pay us too. It's sort of like a way to get rewarded for buying into strong, stable companies and holding them. And while I'm on the topic of strong companies, I wanted to quickly hit you guys with a few characteristics or things to look out for when you're researching or looking for a high quality company to invest in. The very first thing to look out for is to see if they're leaders in their field. For example, I'd consider Nike to be a leader in the footwear and clothing field. Like I mentioned in a prior video, you just can't go outside without seeing somebody wearing some sort of Nike gear. Knowing that they have a strong brand lets me know that they're gonna be here for a while. The very next thing to look out for is revenue growth. We want companies that have the revenue trending upwards. Costco is a great example. Their revenue has steadily gone up for years now, which is also great because it not only shows that they can maintain their dividend, they can also keep growing it as well. And the third thing to potentially look out for when you're looking for high quality companies is how many years they've actually grown their dividend. This is really gonna let you know how reliable they are in terms of them actually paying you. I mean, just take a look at Coca-Cola, for example. Those guys have continued to pay and raise their dividend dividend for over 50 years, which is just crazy. But anyways, if you guys are looking to go more in depth into researching companies, you can go ahead and check out my How to Research Companies video. It's going to be linked somewhere here on the screen. It's a must watch that's filled with tons of gems. And for all my people out there that aren't really trying to put in the time and effort to invest into individual companies, there's also a way to invest and still get paid through something called an index fund. Index funds basically just allow you to invest, sit back, and collect your dividends. They're essentially baskets in the stock market that are filled with tons of different types of companies. And like I just mentioned, they also happen to pay dividends as well. You'd basically own just about all the companies in the stock market by buying one index fund. Index funds also have qualifications for the companies that can be in them as well. So if a company stops paying a dividend, for example, the index fund will just replace it with another one. I don't happen to own any as of right now on my main portfolio, but I do happen to own a few on my retirement portfolio. I own VOO, SPHD, SCHD, and VYM. I'd say those are a few good ones to look into if you're gonna follow through with a more laid back style of investing. And that's all I got for you guys today. I wanted to use today's video to hopefully help educate you guys a bit and hopefully answer a few questions. If there's something that I missed out on or you're still curious about, definitely feel free to let me know down in the comments below. I'm always more than happy to help you guys out as best as I can. And with all that being said, beat the odds and do the numbers. I'll catch you guys on the next one. Peace.